And having listened to all of you and the questions that have been asked about who decides, we were consulted by the executive through the leader of government business. And having applied my mind as the speaker, it was clear that there was no budget that would be tabled. It was for that reason that I consulted all the parties, and I understand Honorable Nkwankwa unfortunately did not make that meeting, though two of the parties did express their concerns, but unanimously all parties agreed that we postponed. And Honorable Malima, I said two parties, which is the EFF is one, MK is another. Yeah. No, ATM was not in that meeting. So can you please not raise those issues which were not part of the meeting? Honorable members, clearly I've listened to the views of all parties, and I think it is in the interest of all of us and the people of South Africa that we postpone and allow time to the Treasury to finalize whatever they need to finalize. You wanted certainty. Executive has given us the date of 12 March to come and present. As this parliament, we are not going to compromise our timelines as to how we need to deal with that budget. So no time will be shortened for us to deal with these issues in terms of our timelines. So I want to thank honorable members and adjourn the House. Thank you.
The head of South Africa's largest asset management firm, 91, says the unprecedented postponement of the budget just before it was scheduled to be tabled in Parliament is not a crisis. He added that the need to resolve differences over tax hikes points to democracy in action. For others, it highlighted the cracks within the government of national unity and raises more uncertainty on if the South African government can advance a credible budget not lumbered by crippling compromises, a budget urgently needed to support a credible long-term growth plan, talk less of the discipline needed for its implementation. The rand weakened significantly as markets were sent on a panic following the unprecedented postponement of the budget speech to March 12, 2025. Hello, this is Bode Oshosami on Global Business Insights, where we look closer at the main business headlines. Today, we look at how investors are dealing with more than usual domestic and global turmoil playing all over the world, and focuses on an asset class that is back at the top of the menu for investors. Increased geopolitical tensions, whether in Ukraine, Middle East, or from Trump 2.0, and projections of below average global growth are causing many to seek out gold, the safer heaven metal. First, some of the main stories. Apple just dropped a budget-friendly surprise, the new iPhone 16e priced at $599 with AI capabilities hitting shelves at the end of February. Apple is not docking out of the price war as consumers look for cheaper alternatives with all the latest AI smartphone features. Microsoft also unveiled a new kind of quantum computer chip called Majorana 1, making quantum computing available in the near future. This will enable hyper-complex tasks at the mega speed needed to research topics including material sciences and healthcare. Profits of mining giant Rio Tinto sank to the lowest in 5 years as lower prices for iron ore outweighed growth in its copper and aluminium businesses. This was as weak demand from China's struggling property sector and high portside inventories hit the miners' profits. But let's switch to another metal that is not doing so badly, gold. Tunde Fagbemi, chairman of Dukia Gold, a mines to market initiative that is incubating several gold-related projects, including a world-class gold and precious metals refinery. Is here and he weighs first on how the geopolitics and Trump 2.0 has affected the gold market. He also comments on today's Nigeria Central Bank monetary policy meeting decision on rates.
Bode, it's always a pleasure to be with you. Again, I must thank you for your many podcasts and shows. Your daily podcast has been of extreme use to all of us in the industry. And me and my colleagues at Dukia Gold look forward every day to receiving your podcasts, including the many unique insights that you present. Gold will retain and has retained and would always retain its premier position as a safe haven asset. It's not going to change. Whether it's 0% or 25%, it won't really matter, because at least for the first time, the tariff, which ought to be governed by an OECD WTO arrangement, is gone unilateral. It's done that to even affect the reasonableness of where do I keep my gold. If you keep gold in the US, you're safe now. But if your gold is in England, London to be precise, and you have to repatriate it under the new Trump pronouncements, what will happen automatically is that what you bought at $1,000, technically, you'll need to pay 25% tariff on it, on import. It instantly increases the value of your gold at purchase from 1,000 to 1,000 plus 25%, which is 1,250. Can you pass that cost to the next person? I don't know. So what's really happened now is that for the very first time, any American or any trader in America who has a gold position away from America has had to panic and send a message for the allocated gold that is held in the vault, especially in England, to come back to the US. What has that done? It's created an arbitrage. It's created opportunities for people for the very first time to see the dislocation between the COMEX and the LBMA. And it also caused a huge amount of gap in terms of demand, supply, and the complexities that surround logistics for gold. The recent pronouncements of Trump has again asked and shown the world, is the American dollar going to become dominant? Would it become more expensive? If it becomes more expensive, then it's obvious that the exchange rate between every local currency and the American currency would need to find its own level. So it wouldn't really matter how hard you struggle in your country. If the dollar is too strong, you're going to have to pay more to buy the dollar. What does that do? You've got to find an escape route for your local currency to have a value or some kind of asset or commodity that can help you fight and hopefully win the war. Gold presents that opportunity, and because it presents that opportunity as a safe haven in economic instability and market volatility, the price of gold is bound to inch higher by the day and over the period. And we know today that the general direction of the price of gold is to head towards the 3,000 mark and go from 3,000 mark and beyond. Regarding the industrial use of gold, especially in the new Trump administration and policies, aerospace is going to play large. In fact, one of his best friends is Elon Musk. Elon Musk is big on aerospace. Boeing is big on aerospace. Virtually everyone in America recognizes the fact that there's going to be a lot of more play in aerospace and especially in the military industrial complex. The 5G and the Internet of Things is bound to take a large play in all of this. We all know that even the mobile phone carries more gold than some earrings and some pendant that we wear. Therefore, there's going to be a lot more gold going to quite a lot of industrial use. Again, because the military industrial complex is going to require a lot of precious metals, and indeed is allowed once again the use of petrol cars, which is going to require more catalytic converter. Indeed, whether you then buy gold as a safe haven investment or as an asset class to diversify your portfolio, or you are holding it because you are certain that somebody is going to make a demand for it for industrial use, it makes a lot of sense to buy gold and hold. It also makes a lot of good sense to buy gold not in jewelry, but as investment grade allocated gold. I am afraid most Africans who import out of the US may actually be importing part of the inflation of 25% brought about by tariff into their country. Inflation is bound to be on the increase in the US and may actually be elevated around the world. So if inflation is 2 to 3% in the US, locally inflation has gone from 34% to 24% in Nigeria. Nobody should kid you. Inflation in Nigeria is still highly elevated. If we have to add 25% imported inflation from America to 24, then get ready, tighten your seatbelt. It may not be as easy as we think. I believe that most portfolio managers would need to continuously ask themselves, yes, what do I do to balance my books? Of course, interest rate would affect the quantum of investment on the stock exchange or in the capital market, like they say, or perhaps in the purchase of bonds. But whatever happens, especially in a elevated interest rate situation, which is compounded by inflation, gold will continue to be the natural choice for you to invest in, especially to diversify and to protect you from the very many uncertainties. Regarding the MPC meeting and the central bank, in consideration of the many news that have come from the Bureau of Statistics, especially regarding inflation, I think they've all got their job cut out for them. First, there is a budget to review in terms of initial performance over the last 6 or so weeks. There is the fact that inflation has been rebased from the current 37 plus back to 24. And for the first time, we will have inflation at a lower rate compared to the lending rate or the price of naira. The capital market is a very fragile situation right now. In my understanding, the foreign exchange market is also finally trying to find its level. To tweak anything at this time may hinge on disequilibrium again, and it would be very interesting to see how they manage that one.
Asia Pacific markets were mostly lower as investors continue to digest possible tariffs, as well as hawkish FOMC meeting minutes released yesterday reaffirming expectations for keeping rates higher for longer. The risk-off mood lifted gold prices to a record high at $2,950 per ounce, while the safe haven Japanese yen also firmed to its highest level since early December against the dollar. Well, that's all we can take on this episode of Global Business Insights. Thanks for watching. This is Bode Oshosani. Bye-bye.